Hello, everyone. Welcome back to Financial Path. Today, we'll discuss a critical question on everyone's mind. Will the Federal Reserve cut interest rates at its June FOMC meeting? Based on the latest data and careful analysis, our conclusion is clear. The Fed won't cut rates in June. Let's dive deeply into why this is the case. First, let's examine the inflation scenario. The latest Consumer Price Index, CPI report, released on June 11, 2025, shows the inflation measured by headline CPI rose slightly in May to a year-over-year rate of 2.4%, up marginally from April's 2.3%. The May monthly inflation also rose slightly by 0.1%. Though the monthly inflation rate was lower than what economists expected, the slight upward tick in yearly inflation from the April yearly inflation after a prolonged period of decline still makes the Fed cautious. The Federal Reserve's primary goal regarding inflation is to achieve and maintain a core CPI inflation rate of around 2%. Currently, the core CPI for May, which excludes volatile food and energy prices, remains at a stubbornly high 2.8%. This figure has not changed from April, showing that inflationary pressures still exist. With headline inflation slightly increasing to 2.4%, the Fed faces increased pressure to act cautiously. Lowering interest rates now could risk triggering a higher inflation rate in the second half of the year, making it even more challenging for the Fed to meet its long-term target of 2% inflation. Thus, based solely on inflation data, not only should the Fed avoid cutting rates, it might even be inclined to raise them slightly to combat potential future inflationary pressures. However, inflation isn't the only factor guiding the Fed's monetary policy. Another crucial gauge is the state of the labor market, which the Fed carefully considers before making any policy changes. The latest employment data, released on June 6, 2025, reveals that non-farm payrolls increased by 139,000 in May, and the unemployment rate held steady at 4.2%. The April revised job addition was $147,000. The key takeaway here is that despite the job addition slowing down slightly, the labor market still shows signs of healthy growth. Stable unemployment at 4.2%, a historically low rate, indicates that the Fed isn't under significant pressure to stimulate job creation further by cutting interest rates. The labor market remains sufficiently strong, thereby reducing any urgency or necessity for rate cuts. Now let's combine these two primary factors, inflation and employment, to understand the Fed's likely decision better. Given the dual mandate of the Federal Reserve, any decision on rate changes must carefully balance these indicators. Currently, neither the employment market nor inflation conditions compel the Fed to cut rates. Inflation's slight uptick necessitates caution, and the robust job market doesn't indicate immediate action is needed. Therefore, it's logical to predict that the Fed will likely maintain interest rates steady during their June meeting. There's another critical factor complicating the Fed's decision-making process: the ongoing tariff situation. When the expert expected the May 2025 inflation rate, they thought Trump's tariff would begin to impact the economy, so they gave a higher expectation of the May inflation. However, the released May inflation data indicates that the tariffs imposed by President Trump haven't significantly impacted inflation yet, likely due to companies pre-building inventories at pre-tariff prices. Even though, like this, analysts now widely expect the full impact of tariffs to gradually reflect in inflation data over the coming months. Despite the current trade war truce between the US and China, uncertainties remain. Recent reports suggest that the second round of trade negotiations held in the UK yielded positive outcomes, leading many experts to believe that the truce may be extended, possibly resulting in a more permanent and positive resolution. If this scenario materializes, the potential negative impact of tariffs on inflation and employment could be significantly mitigated. Given these uncertainties, the Fed will likely adopt a cautious wait-and-see approach to gather more clarity on future economic conditions before deciding to cut rates. Market predictions further support our analysis. According to the CME Group's FedWatch tool, the likelihood of the Fed cutting rates in the June 18th meeting remains extremely low. As of June 12, 2025, the tool shows that with 97.5% probability, the Fed will maintain its current rate within the range of 425-450. The probability of lowering the rate to 404.25 is only 2.5%, indicating widespread market agreement with our analysis. Interestingly, the odds of a rate cut in subsequent months, particularly by September, have increased to over 79% after the May inflation data was released on 11th of June 2025, when the probability of lowering the rate is only about 69%. This reflects market anticipation that economic conditions might warrant a cut later this year. However, these predictions remain fluid and subject to significant changes depending on forthcoming economic data. Another notable factor influencing market sentiment is President Trump's vocal stance. On his Truth Social platform, Trump explicitly advocated for a dramatic one-point rate cut. He argues that the current inflation scenario justifies an aggressive rate cut and suggests that if inflation subsequently rises, the Fed could always reverse course. However, Federal Reserve Chairman Jerome Powell has consistently emphasized that the Fed operates independently, free from political pressures, and guided solely by data. Powell's clear message is that monetary policy will be based on economic fundamentals rather than external political influence. In conclusion, based on the thorough analysis of inflation data, labor market conditions, tariff uncertainties, market predictions, and maintaining the Fed's independence, it's logical and prudent to conclude that the Federal Reserve will not cut interest rates during the June FOMC meeting. They will likely adopt a cautious approach, carefully monitoring economic indicators and global trade developments. We expect more clarity from the upcoming Fed press conference following the June meeting. Stay tuned for more updates. Don't forget to like, comment, and subscribe to stay informed. Thank you for watching and see you next time.